Hello and welcome. In this course, we will explore the effects of changes in foreign exchange rates based on International Accounting Standard 21. The standard that deals with the effects of changes in foreign exchange rates has gone through several developments over the years. It was first introduced back in 1983, aiming to provide guidance on how to account for transactions and balances involving foreign currencies. Later, in 2001, the responsibility for the standard was taken over by the International Accounting Standards Board. A major update came in 2003, when the standard was revised to include additional guidance and to reflect changes in the global financial environment. This revision brought together several related interpretations into one cohesive standard, making it easier for companies to understand how to handle currency issues in their financial reporting. It also included some important updates to reflect the introduction of new currencies like the euro. Overall, these changes aim to create a more consistent and comprehensive approach to accounting for foreign exchange differences. Over time, the standard has continued to evolve to address new challenges and improve consistency in financial reporting. In 2005, an important update required that certain foreign exchange differences from monetary items be shown separately in equity, providing clearer insight into how currency movements affect a company's financial position. More recently, in 2023, further changes were introduced to help companies deal with situations where a currency cannot be freely exchanged for another. These updates offer clear guidance on how to determine the right exchange rate to use in such cases and what kind of information should be disclosed to ensure transparency. In addition to these major revisions, other updates have been made over the years as part of broader improvements in financial reporting standards. These changes have helped ensure that IAS 21 remains aligned with modern financial practices and continues to support accurate and consistent reporting across different industries and regions. This accounting standard is structured to provide a comprehensive understanding of how to deal with the effects of changes in foreign exchange rates. It includes a full set of guidelines and examples designed to support consistent application across different situations. While all the sections carry the same level of importance, the format used still reflects the structure from when the standard was first introduced. To fully understand and apply it, it's important to consider the overall purpose of the standard and the principles that support financial reporting as a whole. In cases where the standard does not give specific instructions, companies are expected to use judgment based on broader accounting principles to choose the most appropriate approach. This ensures that financial information remains reliable and relevant, even in more complex or unusual situations. Companies often operate across borders, which means they may deal with foreign currencies in their transactions or even have entire operations based in other countries. Sometimes, they also choose to present their financial statements in a different currency. The main goal of this standard is to provide clear guidance on how to reflect these foreign currency activities in the financial statements. It explains how to account for transactions and operations involving different currencies and how to convert financial information into the currency used for reporting. One of the key challenges is deciding which exchange rates to apply and how to properly show the impact of currency movements in the financial reports. This helps ensure that the financial statements remain accurate, consistent, and easy to understand, even when multiple currencies are involved. This standard applies to situations where a company deals with foreign currencies in its day-to-day accounting. It covers how to handle transactions and balances that involve other currencies, except for certain financial instruments that are addressed by a different standard. It also applies when a company includes foreign operations, such as subsidiaries or joint ventures, in its financial statements, whether through consolidation or the equity method. Finally, the standard provides guidance on how to translate a company's overall financial results and position into the currency used for presenting its financial statements. This ensures consistency and clarity when reporting financial information across different countries and currencies. While many foreign currency derivatives fall under the rules of a separate standard focused on financial instruments, there are some exceptions. Certain types of derivatives, especially those that are part of larger contracts, are not covered by that standard and instead fall within the scope of this one. In these cases, the guidance provided here applies. This standard also comes into play when a company needs to convert amounts related to derivatives from the currency it uses for its day-to-day operations into the currency it uses to present its financial statements. This ensures that even complex financial instruments are translated and reported consistently. This standard does not cover hedge accounting for foreign currency items, such as when a company is trying to protect itself from currency risk related to investments in foreign operations. Those topics are addressed by a different standard focused specifically on hedge accounting. However, this standard does apply when a company chooses to present its financial statements in a different currency. It outlines the rules that must be followed for those statements to be considered fully compliant with international reporting standards. If a company translates financial information into another currency without following these rules, the standard also explains what kind of information needs to be disclosed. It's important to note that this standard does not apply to how foreign currency transactions are presented in the cash flow statement or how the cash flows of a foreign operation are translated. To understand and apply this standard properly, it's important to be familiar with a few key terms. The term closing rate refers to the exchange rate available at the end of the reporting period. This is the rate used when converting foreign currency amounts into the reporting currency at the period's close. When we say that a currency is exchangeable into another, we mean that a company can obtain the other currency within a reasonable time frame, using a market or official mechanism that ensures the transaction is legally binding. Exchange difference describes the variation that occurs when converting the same amount of money from one currency to another using different exchange rates. These differences can arise due to changes in exchange rates over time and need to be accounted for in financial reporting. Let's go over a few more important terms used in this standard. The exchange rate simply refers to how much of one currency you get in exchange for another. Fair value is the amount someone would reasonably expect to receive for selling an asset or to pay for transferring a liability, assuming the deal takes place in an orderly market between willing participants at a specific point in time. A foreign currency is any currency that is different from the one the company normally uses in its operations. A foreign operation refers to a part of the business, such as a subsidiary, branch, or joint venture, that operates in a different country or uses a different currency. The term functional currency means the main currency of the economic environment where the company earns and spends most of its money. Finally, a group refers to a parent company and all the companies it controls. Now, let's look at a few final definitions that are essential for understanding the standard. Monetary items include cash and any assets or liabilities that are to be received or paid in a fixed or clearly defined amount of currency. A net investment in a foreign operation refers to the total interest a company has in the net assets of one of its foreign branches, subsidiaries, or similar entities. The presentation currency is the currency in which a company chooses to present its financial statements, which may be different from the currency it normally operates in. Lastly, the spot exchange rate is the rate at which one currency can be exchanged for another for immediate delivery. When determining if a currency is exchangeable, a company evaluates this at a specific measurement date and for a particular purpose. If at that time, the company can only obtain a very small or insignificant amount of the other currency needed for that purpose, then the currency is considered not exchangeable. This assessment helps companies decide which exchange rates to use when preparing their financial statements and ensures the information reflects real market conditions. The functional currency is generally the currency of the primary economic environment where a company carries out its business activities and generates most of its cash. To determine this, a company looks at several key factors. First, it considers the currency that most influences the sales prices of its goods and services, which is often the currency in which those prices are set and payments are made. It also takes into account the currency of the country, whose competitive conditions and regulations have the biggest impact on the pricing of its products or services. Additionally, the company considers the currency that mainly affects its costs, including labor, materials, and other expenses related to providing goods or services, which is usually the currency in which these costs are billed and paid. There are also other factors that can help determine a company's functional currency. One of these is the currency in which the company raises funds, such as through issuing debt or equity. Another important factor is the currency in which the company usually keeps the cash it generates from its regular business activities. When it comes to a foreign operation, additional factors are considered to decide its functional currency and whether it is the same as the currency used by the parent or reporting company. This helps ensure accurate financial reporting for all parts of the business. To determine the functional currency of a foreign operation, it is important to consider whether its activities are carried out as an extension of the parent company or if it operates with a significant level of independence. For example, if the foreign operation mainly sells goods imported from the parent company and sends the earnings back, it is closely linked to the parent. On the other hand, if the operation manages its own cash, expenses, income, and borrowing mostly in its local currency, it acts more independently. Other factors include the extent of transactions between the foreign operation and the parent company, and whether the cash flows from the foreign operation directly impact the parent company's cash flows and are easily available for transfer. Another factor to consider is whether the cash flows generated by the foreign operation are enough to cover its own debt obligations, without needing financial support from the parent company. When these factors provide mixed signals and it's not clear which currency should be used, management must use their judgment to decide on the functional currency that best reflects the true economic effects of the company's transactions and activities. In making this decision, management focuses first on the primary indicators, such as sales prices and costs, before looking at other supporting factors to ensure the chosen currency truly represents the business environment. An entity's functional currency reflects the key transactions, events, and conditions that affect its operations. Once the functional currency is established, it should only be changed if those underlying circumstances change significantly. If the functional currency belongs to a hyperinflationary economy, the entity must restate its financial statements following the relevant accounting standards for such economies. It is not acceptable for an entity to avoid this restatement by simply choosing a different functional currency, such as that of its parent company. The functional currency must always reflect the true economic environment of the entity. An entity might have monetary items owed to or by a foreign operation. If these amounts are not expected to be settled in the near future, they are considered part of the entity's net investment in that foreign operation. This includes items like long-term loans or receivables, but it does not include everyday trade receivables or payables. These net investments are accounted for following specific guidelines. A monetary item receivable from or payable to a foreign operation can belong to any subsidiary within a group. For example, if a group has two subsidiaries, A and B, where subsidiary B is a foreign operation, and subsidiary A lends money to subsidiary B, then subsidiary A's loan to subsidiary B would be considered part of the net investment in subsidiary B, provided the loan is not expected to be settled in the near future. This also applies if subsidiary A is itself a foreign operation. Monetary items are assets or liabilities involving a right to receive or an obligation to pay a fixed or determinable amount of currency. Examples include pensions and employee benefits payable in cash, cash-settled provisions, lease liabilities, and recognized cash dividends. Also, contracts to receive or deliver a variable number of an entity's own equity instruments or variable assets with a fair value equivalent to a fixed or determinable currency amount are monetary items. On the other hand, non-monetary items do not involve rights or obligations to receive or pay a fixed or determinable amount of currency. Examples include prepaid amounts for goods or services, goodwill, intangible assets, inventories, property, plant and equipment, right-of-use assets, and provisions settled by delivering non-monetary assets. Here's a summary of the approach required by IAS 21. Summary of the approach. When preparing financial statements, every entity, whether a standalone entity, an entity with foreign operations, like a parent company, or a foreign operation itself, such as a subsidiary or branch, must determine its functional currency following the guidance in paragraphs 9-14. Translate all foreign currency transactions and balances into its functional currency. Report the effects of these foreign currency translations according to the rules set out in paragraphs 20, 37, and 50. Many reporting entities are made up of several individual entities, like a group that includes a parent company and one or more subsidiaries. These entities might also have investments in associates, joint arrangements, or branches. Because of this, it's important to translate the financial results and position of each individual entity into the currency that the overall reporting entity uses to present its financial statements, called the presentation currency. IAS 21 allows this presentation currency to be any currency or even multiple currencies. When an individual entity's functional currency is different from the presentation currency, its financial statements need to be translated according to specific rules outlined in the standard. The same applies to standalone entities or those preparing separate financial statements under IAS 27. If their presentation currency differs from their functional currency, their results and financial position must also be translated using these rules. When a currency is not exchangeable into another currency at a specific measurement date, an entity must estimate the spot exchange rate for that date. The goal of this estimation is to reflect the rate at which an orderly exchange transaction would happen between market participants under the current economic conditions. This means the estimated rate should represent a realistic and fair value, as if the currencies were being exchanged in a normal market. A foreign currency transaction is any transaction that is denominated or settled in a currency other than the entity's functional currency. This includes situations when an entity buys or sells goods or services priced in a foreign currency, borrows or lends money where amounts payable or receivable are in a foreign currency, or acquires or disposes of assets, or incurs or settles liabilities that are denominated in a foreign currency. When a foreign currency transaction is initially recognized, it should be recorded in the entity's functional currency by applying the spot exchange rate between the functional currency and the foreign currency on the date of the transaction. The transaction date is when the transaction first meets the criteria for recognition under IFRS. For convenience, entities often use an exchange rate that approximates the actual rate on that date, such as an average rate for a week or a month, applied to all transactions in that foreign currency during the period. However, if exchange rates fluctuate significantly, using an average rate over the period is not appropriate. At the end of each reporting period, foreign currency monetary items must be translated using the closing exchange rate. For non-monetary items measured at historical cost in a foreign currency, the exchange rate at the date of the original transaction is used for translation. Meanwhile, non-monetary items measured at fair value in a foreign currency are translated using the exchange rate at the date when that fair value was determined. The carrying amount of an item is determined by applying the relevant accounting standards. For instance, property, plant, and equipment can be measured either at fair value or historical cost according to IAS 16. Regardless of whether the carrying amount is based on historical cost or fair value, if it is initially determined in a foreign currency, it must then be translated into the functional currency following the rules of this standard. The carrying amount of some items is determined by comparing two or more amounts. For example, inventories are carried at the lower of cost and net realizable value according to IAS 2. Similarly, under IAS 36, if there is an indication of impairment, the carrying amount of an asset is the lower of its carrying amount before impairment and its recoverable amount. When such an asset is non-monetary and measured in a foreign currency, the carrying amount is determined by comparing these amounts after translation. For non-monetary assets measured in a foreign currency, the cost or carrying amount is translated using the exchange rate at the day when that amount was determined, typically the rate at the date of the transaction if measured at historical cost. Meanwhile, the net realizable value or recoverable amount is translated using the exchange rate at the date when that value was determined, such as the closing rate at the end of the reporting period. The result of this comparison might be that an impairment loss is recognized in the functional currency, but not in the foreign currency, or the other way around. When multiple exchange rates are available, the rate applied is the one at which the future cash flows of the transaction or balance could have been settled, assuming those cash flows occurred at the measurement date. When it comes to recognizing exchange differences, IFRS 9 plays a key role, especially for hedge accounting involving foreign currency items. Hedge accounting means that some exchange differences are treated differently than usual under this standard. For example, if a monetary item is part of a cash flow hedge and qualifies as a hedging instrument, the exchange differences on that item are initially recorded in other comprehensive income, but only to the extent that the hedge is effective. Exchange differences that arise when monetary items are settled or when they are translated at exchange rates different from those used at initial recognition or in previous financial statements must be recognized in profit or loss in the period they occur. The only exception to this rule is described in paragraph 32. When a monetary item arises from a foreign currency transaction, any change in the exchange rate between the transaction date and the settlement date results in an exchange difference. If the transaction is settled within the same accounting period it occurred, the entire exchange difference is recognized in that period. However, if the settlement happens in a later accounting period, the exchange difference recognized in each period up to settlement is based on the change in exchange rates during that specific period. When a gain or loss on a non-monetary item is recognized in other comprehensive income, the exchange component of that gain or loss must also be recognized in other comprehensive income. On the other hand, if the gain or loss on the non-monetary item is recognized in profit or loss, then any exchange component should be recognized in profit or loss as well. Other IFRS standards require certain gains and losses to be recognized in other comprehensive income. For example, IAS 16 mandates that some gains and losses from revaluing property, plant, and equipment be recognized in other comprehensive income. When such an asset is measured in a foreign currency, this standard requires that the revalued amount be translated using the exchange rate at the date the value was determined. This translation creates an exchange difference, which is also recognized in other comprehensive income. Exchange differences arising from a monetary item that is part of a reporting entity's net investment in a foreign operation are recognized in profit or loss in the separate financial statements of either the reporting entity or the foreign operation, depending on the context. However, in consolidated financial statements, which include both the foreign operation and the reporting entity, these exchange differences are initially recognized in other comprehensive income. Then, when the net investment is disposed of, the accumulated exchange differences are reclassified from equity to profit or loss. When a monetary item is part of a reporting entity's net investment in a foreign operation, the recognition of exchange differences depends on the currency denomination. If the item is denominated in the functional currency of the reporting entity, the exchange difference arises in the foreign operation's individual financial statements. If it is denominated in the functional currency of the foreign operation, the exchange difference arises in the reporting entity's separate financial statements. However, if the item is denominated in a currency other than the functional currency of both the reporting entity and the foreign operation, exchange differences arise in both the reporting entity's separate financial statements and the foreign operation's individual financial statements. In the consolidated financial statements, or those prepared using the equity method, these exchange differences are recognized in other comprehensive income. When an entity maintains its books and records in a currency different from its functional currency, it must translate all amounts into the functional currency when preparing its financial statements. This translation ensures that the amounts in the functional currency are the same as if the items had originally been recorded in that currency. For example, monetary items are translated using the closing exchange rate, while non-monetary items measured at historical cost are translated using the exchange rate at the date of the transaction that led to their recognition. When an entity changes its functional currency, it must apply the translation procedures for the new functional currency going forward from the date the change occurs. The functional currency reflects the underlying transactions, events, and conditions that are important to the entity. Therefore, a change in functional currency is only allowed if there is a significant change in those underlying factors. For example, if the currency that mainly affects the sales prices of the entity's goods and services changes, this may result in a change to the entity's functional currency. The effect of changing the functional currency is accounted for going forward or prospectively. This means the entity translates all items into the new functional currency using the exchange rate on the date of the change. For non-monetary items, the translated amounts become their new historical cost. Also, any exchange differences from translating a foreign operation that were previously recorded in other comprehensive income stay in equity and are only moved to profit or loss when the foreign operation is disposed of. An entity can choose to present its financial statements in any currency it prefers. When the presentation currency is different from the entity's functional currency, the entity translates its financial results and position into the chosen presentation currency. For example, in a group with several entities that each have different functional currencies, the results and financial position of each individual entity are converted into a common currency. This allows the group to present consolidated financial statements in a single, consistent currency. When an entity's functional currency is not from a hyperinflationary economy, but it presents its financial statements in a different currency, specific translation rules apply. Assets and liabilities on each statement of financial position, including comparative figures, are translated at the closing exchange rate on the date of that statement. Income and expenses for each profit or loss and other comprehensive income statement, including comparatives, are translated at the exchange rates on the dates of the transactions. Any exchange differences that arise from this translation are recognized in other comprehensive income. For practical purposes, entities often use an average exchange rate for the period to translate income and expenses, but if exchange rates fluctuate significantly during the period, using an average rate is not appropriate. The exchange differences mentioned arise mainly from translating income and expenses using exchange rates on the transaction dates, while assets and liabilities are translated at the closing rate. They also result from translating the opening net assets at a closing rate that differs from the previous period's closing rate. These exchange differences are not recorded in profit or loss because changes in exchange rates usually have little or no direct impact on the current and future cash flows of operations. Instead, the total exchange differences are shown as a separate component of equity until the foreign operation is sold or disposed of. If the foreign operation is consolidated but not fully owned, any accumulated exchange differences that relate to non-controlling interests are assigned to those non-controlling interests and reported as part of them in the consolidated financial statements. When an entity's functional currency is from a hyperinflationary economy and it needs to present its financial statements in a different currency, all amounts, including assets, liabilities, equity, income, and expenses, plus comparative figures, should be translated using the closing exchange rate on the date of the most recent financial statement. However, if these amounts are translated into the currency of a non-hyperinflationary economy, the comparative amounts should be the same as those reported in the prior year's financial statements as current year amounts, without adjusting for changes in price levels or exchange rates after that date. When an entity's functional currency is from a hyperinflationary economy, it must first adjust or restate its financial statements according to IAS 29. Financial reporting in hyperinflationary economies before translating those statements into another currency, as described earlier. However, this restatement is not applied to comparative amounts if they are translated into a currency of a non-hyperinflationary economy. When the economy stops being hyperinflationary and the entity no longer applies IAS 29, it should treat the restated amounts at that stopping point as the new historical costs for translating into the presentation currency. When a foreign operation's financial results and position are translated into the reporting entity's presentation currency for consolidation or equity method purposes, paragraphs 38, 43, and 45, 47 apply. The results and financial position of the foreign operation are combined with the reporting entity's accounts using normal consolidation rules. This includes eliminating transactions and balances between entities within the group. However, monetary assets and liabilities between group entities cannot be eliminated against each other without recognizing the effect of currency fluctuations. For example, if one company in the group has a receivable from another in a different currency, exchange rate changes create gains or losses. These exchange differences from intra-group monetary items must be recognized in the consolidated financial statements. Usually, the exchange differences are recognized in profit or loss, But if the exchange difference arises from specific hedge accounting or net investment scenarios, as described in paragraph 32, it is recognized in other comprehensive income and held in equity until the foreign operation is disposed of. Sometimes a foreign operation prepares its financial statements as of a different date than the parent company's financial statements. Ideally, the foreign operation will create additional statements that match the reporting date of the parent. This makes it easier to combine the numbers. However, if the foreign operation does not prepare statements at the same date, the rules allow using a different date, but only if the difference is no more than 3 months. Also, any significant transactions or events that happen between the two dates need to be adjusted for. When this happens, the foreign operation's assets and liabilities are translated using the exchange rate at the end of its reporting period. Then, adjustments are made for any major changes in exchange rates up to the parent company's reporting date. The same process applies when using the equity method to account for investments in associates and joint ventures. When a foreign operation is acquired, any goodwill or fair value adjustments that arise are treated as assets and liabilities of that foreign operation. This means they are recorded in the foreign operation's functional currency. Finally, when preparing consolidated financial statements, these amounts are translated into the parent company's presentation currency at the closing exchange rate on the reporting date. When a foreign operation is disposed of, either fully or partially, there are some important accounting steps to follow. First, the cumulative exchange differences related to that foreign operation, which have been recognized in other comprehensive income and accumulated in a separate component of equity, need to be handled carefully. At the point of disposal, this accumulated amount is reclassified from equity to profit or loss. This is called a reclassification adjustment. The reclassification happens at the same time that the gain or loss on the disposal of the foreign operation is recognized in profit or loss. In simple terms, the currency exchange gains or losses that were previously kept in equity now impact the profit or loss once the foreign operation is sold. In addition to disposing of an entire interest in a foreign operation, certain partial disposals are also treated as disposals for accounting purposes. First, if the partial disposal results in the loss of control over a subsidiary that includes a foreign operation, it is considered a disposal. This applies even if the entity keeps a non-controlling interest in that former subsidiary after the disposal. Second, if after a partial disposal of an interest in a joint arrangement or an associate that includes a foreign operation, the remaining interest is a financial asset, this too is treated as a disposal. In both cases, these partial disposals require similar accounting treatment as a full disposal of the foreign operation. When a subsidiary that includes a foreign operation is disposed of, the cumulative exchange differences related to that foreign operation and attributed to non-controlling interests are derecognized. However, these amounts are not reclassified to profit or loss. In the case of a partial disposal of such a subsidiary, the entity must reattribute the proportionate share of the cumulative exchange differences recognized in other comprehensive income to the non-controlling interests in that foreign operation. For any other type of partial disposal of a foreign operation, the entity reclassifies to profit or loss only the proportionate share of the cumulative exchange differences that were recognized in other comprehensive income. When there is a partial disposal of a subsidiary that includes a foreign operation, the entity must reattribute the proportionate share of the cumulative exchange differences which have been recognized in other comprehensive income to the non-controlling interests in that foreign operation. In any other type of partial disposal of a foreign operation, the entity reclassifies to profit or loss only the proportionate share of the cumulative exchange differences recognized in other comprehensive income. A partial disposal of an entity's interest in a foreign operation means any reduction in ownership interest, except for certain reductions described in paragraph 48A, which are treated as full disposals. An entity can dispose or partially dispose of its interest in a foreign operation in several ways. This can include a sale, liquidation, repayment of share capital, or abandoning all or part of that foreign operation. However, a write-down of the carrying amount of a foreign operation, whether due to the foreign operation's own losses or because of an impairment recognized by the investor, is not considered a partial disposal. Therefore, no part of the foreign exchange gain or loss that has been recognized in other comprehensive income is reclassified to profit or loss when a write-down occurs. Gains and losses on foreign currency transactions, as well as exchange differences that arise when translating the results and financial position of an entity, including a foreign operation, into a different currency, may have tax effects. These tax effects are accounted for in accordance with IAS 12, which deals with income taxes. In paragraphs 53 and 55 to 57, references to the functional currency apply in the case of a group to the functional currency of the parent company. An entity shall disclose the amount of exchange differences recognized in profit or loss. This excludes those arising from financial instruments measured at fair value through profit or loss in accordance with IFRS 9. The entity must also disclose net exchange differences recognized in other comprehensive income and accumulated in a separate component of equity. Additionally, a reconciliation of the amount of these exchange differences at the beginning and end of the period should be provided. When the presentation currency is different from the functional currency, the entity must state this fact clearly. It should also disclose what the functional currency is and explain the reason for using a different presentation currency. If there is a change in the functional currency of the reporting entity or a significant foreign operation, the entity must disclose both the fact of the change and the reason behind it. Finally, when an entity presents its financial statements in a currency different from its functional currency, it should describe the financial statements as complying with IFRSs only if they meet all the requirements of IFRSs, including the correct translation method. Sometimes an entity presents its financial statements or other financial information in a currency that is not its functional currency, but it does not follow the full requirements of paragraph 55. For example, the entity might convert only selected items from its financial statements into another currency, rather than the entire set. Or if the entity's functional currency is not the currency of a hyperinflationary economy, it might translate all items using only the most recent closing exchange rate. Such partial or simplified conversions do not comply with IFRSs. When this happens, the entity must make the disclosures required in paragraph 57. When an entity presents its financial statements or other financial information in a currency that is different from both its functional currency and its presentation currency, and it does not meet the requirements of paragraph 55, it must follow certain rules. First, the entity should clearly identify this information as supplementary. This means it must be distinguished from the financial information that fully complies with IFRSs. Second, the entity must disclose the currency in which the supplementary information is presented. Finally, the entity must disclose its functional currency and explain the method of translation it used to prepare the supplementary information. When an entity has to estimate a spot exchange rate because its currency cannot be exchanged into another currency, it must provide clear disclosures. These disclosures help users of the financial statements understand how the currency not being exchangeable affects or may affect the entity's financial performance, financial position, and cash flows. To meet this objective, the entity should disclose information about the nature and financial effects of the currency not being exchangeable into the other currency, the spot exchange rates used for the estimation, the process it followed to estimate these rates, and the risks the entity faces because the currency cannot be exchanged into the other currency. Additional guidance on applying these requirements is provided in paragraphs A18 to A20. This standard is effective for annual periods beginning on or after January 1, 2005. Entities are encouraged to apply it earlier if possible. If an entity applies the standard for a period starting before January 1, 2005, it must disclose that fact in its financial statements. Additionally, the amendment titled Net Investment in a Foreign Operation, issued in December 2005, introduced paragraph 15A and amended paragraph 33. Entities must apply these amendments for annual periods beginning on or after January 1, 2006, but earlier application is also encouraged. An entity shall apply paragraph 47 prospectively to all acquisitions occurring after the start of the financial reporting period in which this standard is first applied. Retrospective application of paragraph 47 to earlier acquisitions is permitted but not required. For an acquisition of a foreign operation treated prospectively, but which occurred before the date the standard is first applied, the entity shall not restate prior years. Accordingly, the entity may treat goodwill and fair value adjustments arising on that acquisition as assets and liabilities of the entity, rather than as assets and liabilities of the foreign operation. This means that those goodwill and fair value adjustments are either already expressed in the entity's functional currency or are non-monetary foreign currency items. Such items are reported using the exchange rate at the date of the acquisition. All other changes resulting from the application of this standard shall be accounted for in accordance with the requirements of IAS 8, which covers accounting policies, changes in accounting estimates, and errors. IAS 1, revised in 2007, updated the terminology used throughout IFRSs. It also amended several paragraphs, 27, 30 to 33, 37, 39, 41, 45, 48, and 52. An entity shall apply those amendments for annual periods, beginning on or after January 1, 2009. If an entity applies IAS 1, revised in 2007, for an earlier period, the amendments shall be applied for that earlier period. IAS 27, amended in 2008, added paragraphs 48A to 48D and amended paragraph 49. An entity shall apply those amendments prospectively for annual periods beginning on or after July 1, 2009. If an entity applies IAS 27, amended in 2008, for an earlier period, the amendments shall be applied for that earlier period. Paragraph 60B was amended by the improvements to IFRSs issued in May 2010. An entity shall apply this amendment for annual periods beginning on or after July 1, 2010. Earlier application is permitted. IFRS 10 and IFRS 11 on joint arrangements, issued in May 2011, amended several paragraphs, 3B, 8, 11, 18, 19, 33, 44 to 46, and 48A. An entity shall apply those amendments when it applies IFRS 10 and IFRS 11. IFRS 13, issued in May 2011, amended the definition of fair value in paragraph 8 and amended paragraph 23. An entity shall apply those amendments when it applies IFRS 13. The presentation of items of other comprehensive income, which is an amendment to IAS 1 issued in June 2011, amended paragraph 39. An entity shall apply this amendment when it applies IAS 1 as amended in June 2011. IFRS 9, issued in July 2014, amended paragraphs 3, 4, 5, 27, and 52, and deleted paragraphs 60, C, 60E, and 61. An entity shall apply those amendments when it applies IFRS 9. IFRS 16 leases, issued in January 2016, amended paragraph 16. An entity shall apply that amendment when it applies IFRS 16. Lack of exchangeability, issued in August 2023, amended paragraphs 8 and 26, and added paragraphs 8A to 8B, 19A, 57A to 57B, and Appendix A. An entity shall apply those amendments for annual reporting periods beginning on or after January 1, 2025. Earlier application is permitted. If an entity applies the amendments for an earlier period, it shall disclose that fact. The date of initial application is the beginning of the annual reporting period in which an entity first applies those amendments. When an entity applies the lack of exchangeability amendments, it should not restate the comparative information from previous periods. Instead, the entity focuses on making adjustments at the date it first applies the amendments. If the entity reports foreign currency transactions using its functional currency, and at the date of initial application, it concludes that its functional currency cannot be exchanged into the foreign currency, or the foreign currency cannot be exchanged into its functional currency, then the entity takes specific steps. It translates all affected foreign currency monetary items, as well as any non-monetary items measured at fair value in that foreign currency, using an estimated spot exchange rate on that date. Any resulting effect from applying this amendment is recorded as an adjustment to the opening balance of retained earnings. On the other hand, if the entity presents its financial statements in a currency different from its functional currency, or if it translates the results and financial position of a foreign operation, it must also assess exchangeability at the date of initial application. If the entity finds that its functional currency, or the foreign operation's functional currency, is not exchangeable into the presentation currency, or vice versa, the entity must translate the affected assets and liabilities using the estimated spot exchange rate at that date. Additionally, if the entity's functional currency is hyperinflationary, it must translate the affected equity items using the estimated spot exchange rate as well. Any effect arising from these translations is recognized as an adjustment to the cumulative translation differences accumulated in a separate component of equity. These steps ensure that the financial statements accurately reflect the economic realities when currencies are not exchangeable, without revising prior period figures. This standard replaces the previous IAS 21, titled The Effects of Changes in Foreign Exchange Rates, which was last revised in 1993. Additionally, this standard supersedes several related interpretations. These include SIC 11, which covers the capitalization of losses resulting from severe currency devaluations. It also replaces SIC 19, which addresses the measurement and presentation of financial statements under IAS 21 and IAS 29 concerning the reporting currency. Finally, SIC 30, which relates to the translation from measurement currency to presentation currency, is also withdrawn by this standard. This is Appendix A, which provides application guidance. It is an integral part of the standard, meaning it should be considered essential when applying the requirements. Now, we'll talk about exchangeability. The purpose of the following diagram is to help entities assess whether a currency is exchangeable. It also guides how to estimate the spot exchange rate when a currency is not exchangeable. Step 1. Assessing whether a currency is exchangeable. Ask yourself, is the currency exchangeable into the other currency at the measurement date for the specified purpose? If the answer is yes, then apply the applicable requirements in IAS 21. If the answer is no, then move to Step 2. Step 2. Estimating the spot exchange rate when a currency is not exchangeable. At the measurement date, estimate the spot exchange rate that meets the objective described in paragraph 19, A, by using either A, an observable exchange rate without adjustment, or B, another estimation technique. Step 1. Assessing whether a currency is exchangeable. Paragraphs A3 to A10 provide detailed guidance to help an entity determine if one currency can be exchanged into another. Sometimes the ability to exchange currencies is not reciprocal. This means that even if currency A can be exchanged into currency B may not necessarily be exchangeable back into currency A. For example, an entity might conclude that currency PC cannot be exchanged into currency LC, even though currency LC can be exchanged into currency PC. Time frame. Paragraph 8 defines a spot exchange rate as the rate for immediate delivery. However, an exchange transaction may not always happen instantly. This can be due to legal or regulatory requirements, or practical reasons such as public holidays. It's important to note that a normal administrative delay in obtaining the other currency does not mean the currency is not exchangeable. What counts as a normal administrative delay depends on the specific facts and circumstances of each case. Ability to obtain the other currency. When assessing whether a currency is exchangeable into another currency, an entity should consider its ability to obtain the other currency, not its intention or decision to do so. Subject to the other requirements in paragraphs A2 to A10, a currency is considered exchangeable if the entity is able to obtain the other currency either directly or indirectly. This holds true even if the entity chooses not to obtain that currency. For example, regardless of whether the entity intends or decides to obtain currency PC, currency LC is exchangeable into currency PC if the entity can either exchange LC directly for PC or exchange LC or for another currency, say FC, and then exchange FC for PC. Markets or exchange mechanisms. When assessing whether a currency is exchangeable into another currency, an entity should consider only those markets or exchange mechanisms where a transaction to exchange the currency for the other currency would create enforceable rights and obligations. Enforceability here means it is supported by law. Whether an exchange transaction in a particular market or exchange mechanism creates such enforceable rights and obligations depends on the specific facts and circumstances. Purpose of obtaining the other currency. In some cases, different exchange rates may apply depending on how a currency will be used. For example, in a country experiencing pressure on its balance of payments, the government may try to discourage capital outflows, such as dividend payments to other countries, while encouraging imports of specific goods. To do this, the authorities might take one of two approaches. First, they could set a favorable exchange rate for buying those essential goods, while imposing a less favorable or penalty rate for capital outflows. Second, they might allow access to foreign currency only for paying for those goods and not for sending money abroad, such as dividends. This results in different exchange rates being applied depending on the purpose of the transaction. Whether a currency is exchangeable into another currency may depend on why the entity needs the other currency, or even why it might need it in a hypothetical situation. So, how should an entity assess this? When an entity reports foreign currency transactions in its functional currency, it should assume that its purpose in obtaining the other currency is to settle or realize individual transactions, assets, or liabilities in that foreign currency. On the other hand, when an entity uses a presentation currency that's different from its functional currency, the purpose should be assumed to be the realization or settlement of the entity's net assets or net liabilities. This means the assessment of exchangeability is not just about whether the exchange is possible, but also why the exchange is needed. Realizing net assets or net investments. An entity's net assets or its net investment in a foreign operation can be realized in different ways. For example, through the distribution of financial returns to the entity's owners, by receiving financial returns from the foreign operation itself, or by recovering the investment either directly or by the owners, such as by selling off the investment. Now, when it comes to assessing whether a currency is exchangeable into another currency, the entity must do this separately for each specific purpose. That means, for example, it should assess exchangeability for reporting foreign currency transactions in its functional currency as a distinct case. And then assess exchangeability again for translating the results and financial position of a foreign operation. Each purpose might have different exchange conditions, so it's important to evaluate them individually. Ability to obtain only limited amounts of the other currency. A currency is not considered exchangeable into another currency if, for a specific purpose, like those outlined in paragraph A7, an entity is only able to obtain an insignificant amount of the other currency. To determine this, the entity must assess the significance of the amount it can obtain. It does this by comparing the amount it's able to get with the total amount it actually needs for that specific purpose. Let's look at an example. An entity has a functional currency of LC, but it has liabilities denominated in currency FC. To assess exchangeability, the entity must ask, can I obtain a meaningful amount of FC to settle those liabilities? If the total amount of FC it can obtain is only a tiny fraction compared to the full amount of liabilities in FC, then FC is not considered exchangeable for that purpose. So it's not about whether any FC is available. It's about whether the amount available is enough to matter in practice. Step 2. Estimating the spot exchange rate when a currency is not exchangeable. When a currency is not exchangeable, the standard does not prescribe a fixed method for estimating the spot exchange rate. Instead, it gives entities the flexibility to use the approach that best meets the objective outlined in paragraph 19a. There are two main options available. The entity may use an observable exchange rate without adjustment. That means using a rate that is already available in the market, as long as it's reliable and reflects an actual exchange scenario. Alternatively, the entity may use another estimation technique. This could involve more complex methods, especially in situations where no market rate is directly available. The key is that whichever method the entity chooses, it must ensure that the result is reasonable and meets the objective of fairly reflecting the exchange rate at the measurement date. Using an observable exchange rate without adjustment. When a currency is not exchangeable, an entity may still be able to estimate the spot exchange rate using an observable exchange rate, as long as that rate meets the objective set out in paragraph 19A. But what does that mean in practice? It means that if there is a rate available in the market that reasonably reflects the conditions for converting one currency into another, the entity can use it without needing to make adjustments. Here are two examples of observable exchange rates the entity might rely on. First, a spot exchange rate for a different purpose than the one being assessed. Even if the rate was used in a different context, it might still fairly represent the exchange rate needed for the entity's purpose. Second, the first exchange rate at which the entity is able to obtain the other currency after exchangeability is restored. This is called the first subsequent exchange rate, and it can be used if it provides a reliable estimate of what the exchange rate would have been at the earlier measurement date. In both cases, the observable rate must still align with the goal of fairly estimating the spot rate at the time of measurement. Using an observable exchange rate for another purpose. Sometimes a currency might not be exchangeable for one purpose, but it might still be exchangeable for another. Let's take an example. Imagine an entity can use a certain currency to import specific goods, but cannot use that same currency to pay dividends. In this case, the currency is exchangeable, but only for a particular purpose. So what should the entity do? If the observable exchange rate available for that other purpose, like importing goods, meets the objective described in paragraph 19A, then the entity can use that rate as the estimated spot exchange rate, even though it relates to a different purpose. The key is whether that rate fairly reflects what the spot exchange rate would have been at the time the entity needed it. In other words, if it still meets the goal of a realistic and unbiased estimate. When an entity wants to use an observable exchange rate for estimating the spot exchange rate, especially when the currency is not exchangeable for the intended purpose, it needs to be careful. The entity must assess whether that rate truly meets the objective described in paragraph 19A. To do that, it should look at several factors. One important factor is whether multiple exchange rates are available in the market. Why does this matter? Well, the existence of several observable exchange rates could signal that those rates are being intentionally influenced. For example, authorities might set different exchange rates to encourage or discourage certain types of currency use, like promoting imports or limiting capital outflows. In these cases, some of the observable rates might include incentives or penalties. This means they don't necessarily reflect the true market value or the actual economic conditions at the time. So, even if a rate is visible and published, an entity needs to judge whether it really represents a fair and neutral estimate of what the spot exchange rate would have been, not just a rate set for a specific policy goal. Factors to consider when using an observable exchange rate. When assessing if an observable exchange rate meets the objective in paragraph 19A, an entity should consider several key factors. First, the purpose for which the currency is exchangeable matters. For example, if the entity can only obtain the other currency for very limited purposes, like importing emergency supplies, the observable exchange rate might not truly reflect the overall economic conditions. It could be skewed by restrictions on usage. Second, the nature of the exchange rate is important. A free-floating exchange rate, one that moves based on market supply and demand, is more likely to reflect the real economic environment. In contrast, an exchange rate set or heavily influenced by regular interventions from authorities might not show the true market value. Finally, the frequency of exchange rate updates should be considered. An observable exchange rate that remains unchanged over long periods is less likely to reflect current economic conditions. On the other hand, rates that update daily or even more frequently tend to provide a better reflection of the prevailing economic reality. Additional factors to consider when using the first subsequent exchange rate. When estimating the spot exchange rate by using the first exchange rate available after exchangeability is restored, the entity should also consider two important factors. First, the time between the measurement date and when exchangeability is restored. The shorter this period, the more likely it is that the first subsequent exchange rate will accurately reflect the prevailing economic conditions. If too much time passes, that rate may no longer represent the market situation at the measurement date. Second, the inflation rates in the economy. In economies experiencing high inflation or even hyperinflation as defined in IAS 29, prices can change rapidly, sometimes several times a day. In such cases, the first subsequent exchange rate may not truly capture the economic reality at the measurement date because of the fast-changing price levels. Using another estimation technique. If an entity chooses to use a different estimation technique to determine the spot exchange rate, it may start with any observable exchange rate. This can include rates from markets or exchange mechanisms where transactions might not create enforceable legal rights or obligations. The entity can then adjust that rate as needed to make sure it meets the objectives set out in paragraph 19a. Disclosure. When a currency is not exchangeable, an entity needs to think carefully about how much detail is required to meet the disclosure objective described in paragraph 57a. It must disclose the information outlined in paragraphs A19 and A20. Additionally, the entity should include any other information necessary to fully satisfy the disclosure objective in paragraph 57a. When applying paragraph 57a, an entity must disclose several key pieces of information. First, it should specify the currency involved and describe the restrictions that prevent that currency from being exchangeable into the other currency. Next, the entity should provide a description of the transactions affected by these restrictions. The carrying amounts of the affected assets and liabilities must also be disclosed. Additionally, the entity should disclose the spot exchange rates it used. This includes stating whether these rates are observable exchange rates without adjustment or spot exchange rates estimated using another estimation technique. If an estimation technique has been used, the entity must describe this technique in detail. This includes providing both qualitative and quantitative information about the inputs and assumptions involved. Finally, the entity should provide qualitative information about the types of risks it faces, because the currency is not exchangeable into the other currency. It should also describe the nature and carrying amount of the assets and liabilities exposed to each of these risk types. When a foreign operation's functional currency is not exchangeable into the presentation currency, or when the presentation currency is not exchangeable into the foreign operation's functional currency, the entity must disclose additional information. First, the entity should provide the name of the foreign operation. It should also specify whether the foreign operation is a subsidiary, joint operation, joint venture, associate, or a branch, and include its principal place of business. Next, the entity must present summarized financial information about the foreign operation. Finally, the entity should disclose the nature and terms of any contractual arrangements that might require it to provide financial support to the foreign operation. This includes describing any events or circumstances that could expose the entity to a loss. Appendix B covers amendments to other pronouncements. These amendments must be applied for annual periods beginning on or after January 1st, 2005. However, if an entity applies the standard for an earlier period, then these amendments must also be applied for that earlier period. It is important to note that the amendments included in this appendix, when the standard was originally issued in 2003, have already been incorporated into the relevant pronouncements published in this volume. The approval of IAS 21, titled The Effects of Changes in Foreign Exchange Rates, revised in 2003, was granted by the 14 members of the International Accounting Standards Board. The board members who approved the standard are as follows: Sir David Tweedy, Chairman; Thomas E. Jones, Vice Chairman; Mary E. Barth; Hans-Georg Bruns; Anthony T. Cope; Robert P. Garnett; Gilbert Gellard; James J. Leisenring; Warren J. McGregor; Patricia L. O'Malley; Harry K. Schmidt; John T. Smith; Jeffrey Whittington, and Tatsumi Yamada. The amendment titled Net Investment in a Foreign Operation to IAS 21, issued in December 2005, was approved by the 14 members of the International Accounting Standards Board. The board members who approved this amendment are Sir David Tweedy, Chairman; Thomas E. Jones, Vice Chairman; Mary E. Barth; Hans-Georg Bruns; Anthony T. Cope; Jan Engström; Robert P. Garnett; Gilbert Gellard. James J. Lysenring, Warren J. McGregor, Patricia L. O'Malley, John T. Smith, Jeffrey Whittington, and Tatsumi Yamada. Lack of exchangeability, which amended IAS 21 The Effects of Changes in Foreign Exchange Rates, was approved for issue by 12 of the 14 members of the International Accounting Standards Board, IASB. 2 members, Mr. Esterer and Miss Kieran, abstained from voting due to their recent appointments to the IASB. The members who approved the amendment are Andreas Barkow, Chairman, Linda Mezon-Hutter, Vice Chairman, Nick Anderson, Patrina Buchanan, Tadeu Sendon, Zach Gast, Jiankao Liu, Bruce McKenzie, Bertrand Perrin, Rika Suzuki, Antar Karen, Robert O. Members who abstained are Florian Esterer and Haggett Karen. Thank you for completing our course and for the attention and dedication you've shown throughout. We are happy to have contributed to your professional development and encourage you to help us improve by providing your feedback. If you have any questions or suggestions, feel free to reach out via email at info@qalever.al or through the contact forms on our website. Also, we invite you to follow us on social media and our YouTube channel to stay updated on upcoming training sessions. Thank you once again, and we look forward to seeing you in our future courses.